So have you ever looked at like a stock before, like something you're interested in, a company, and you like Google it, whether it's on, Yahoo Finance or Bloomberg or something like that. And then all of a sudden you get this like whole list of numbers about what the stock says. Like you don't know what you're looking at, what the dividend ratio, the earnings per share, the PEG ratio.
All the time.
All the time, right?
All those numbers.
It's a lot of them.
I don't know what they mean.
So we're going to take a look at a few stocks today, and I'm going to walk you through what we as a portfolio manager would look at for our clients. We're going to talk about everything from earnings growth to dividends to the market capitalization, the valuation, all that good stuff. So hopefully by the end of this video, and stay tuned because there's some good stuff in here, you'll be able to better analyze a stock for yourself and or have a better conversation with your advisor about the stocks you might have in your portfolio.
Yeah, what numbers mean, what matters, what doesn't. They can't all mean something. They can't all matter.
Well, every single one of them means something, yes. But the relevance to whether or not they're important or not to what you're looking at is what we'll talk about. So not only are we going to show you what the numbers are, we're going to actually walk you through context, right? Like this to me is like a breakdown of like what I would love to have been taught 20 years ago by somebody for like 10, 15 minutes. Like, just break it down for me, man. What's a PEG ratio?
Break it down.
You know what I mean? Just break it down, dude. Instead of having all this kind of like craziness. So we're going to try to break that down for you today. Sound
I can't wait.
So to do that, let's go to the board.
Let's go to the board. I'm a visual learner,
Let's
Brad.
do it.
Let's grab the board.
Welcome to class, people.
Welcome to class.
We thought we'd have some fun, do a little interactiveness with what we're going to talk about today, because this can be a little boring, but stay tuned here because some of these details are actually really important when it comes to a stock. Now, let's start at the top.
Yeah, question.
Go ahead.
Why is it blinking red and green? And is that dollars or like points or something? What's that number represent?
So this currently right now is the price in dollars per share. Okay. Now, as of the recording of this, we have a little over 2 hours left in the market on the West Coast time. It's about 10:45 a.m. What you're seeing here is the price changes of what's going on with the stock currently.
Live.
Now, that actually leads into the first thing I want to bring up. So if you scroll down here for a second, we look at this. The first couple things on here is the previous close. So previous close was yesterday. This stock, the same thing we just looked at, closed at $76.02 a share. So the first thing you can glean is that, hey, it's up today. Green is good, positive is good, right? So that's what's going on right now. Now, it opened this morning. So when the stock market opened, it opened at a price of $75.61. Yes.
How can it close at a price and open at a different price? Does stuff go on in the middle of the night?
It does. That is not for today's show. That is much more complex, but yes.
I feel like every time I ask a question, you always say, oh, that's a different show in itself. And I just want an answer today.
There's market making going on in between hours, thinly traded margins after our trading. That's why there's some differences sometimes. Okay. Just leave it at that. All right.
Trust the process.
I don't want to.
Trust the process. Okay, so now you get into bid ask. This actually has to do with the market making for the day. A bid is where you can actually sell at the market price for a security, and the ask is where you're able to buy it. So it's matching up the bid and the ask. Okay, and this is not something we need to go down the weeds on, nor anyone should when you're looking at fundamentals for a company. But I just kind of want to walk through this first idea here.
Sure.
Okay. Yes.
Can you explain that? That didn't make any sense. It didn't. I'm trying to learn.
I know.
No, good.
This is not where I want you to learn, though.
Wait, this goes back to our point. Some of these matter more than others.
Yes.
Okay.
We'll do the ones that don't matter off camera.
Okay. Well, hold on. I can actually. This is good. I know we want to learn, but a lot of this isn't. This is not what I want to focus on. We're focusing on the peas, not the steak here. Okay. So you're a peas girl. We're going to focus on the steak.
I am a peas
You're
girl.
very much a peas girl. That's okay. But that's a different discussion. That'll take me 20 minutes on each one of these kind of things. We want to keep this concise.
Just give me the meat.
Okay. I want to go to the meat here. This is where you start getting into some ratios that I think are important to look at the fundamentals of the company that you might be investing in. Okay. Days range, pretty simple. It's just kind of showing what the days range has been so far in the trading, what the stock price has been.
Yeah.
52-week range is kind of the same thing. It shows what the annual price has gone through. That's kind of the basics of where we start looking at it. A lot of this makes sense. If they don't make sense, you can look these things up and go through them. But really what I want to focus on is some of the big things that we would look at when we're looking at a stock. The first one I start out with is market cap. So what market cap means, just from a layman's term, it's market capitalization. Essentially what that means is how big of a reach, how big this company is. And the way you get to this number roughly, it's 328, billion, right? Is you roll back up to the top and you can actually take the current price and you multiply it by the amount of shares that are outstanding. Okay? If you multiply those together, that's where you get the market capitalization. Now, for general purposes, this is my rule of thumb. This isn't like hard and fast. My general rule of thumb is if that number of market cap is higher than 10 billion, okay, which is obviously significantly is, it's considered a large capitalized company. You heard of this before? Large cap?
Large cap.
Okay, that's what it means. It just means it's a bigger company, okay? Now, to go further for a second, if that number ends up being between 2 billion and 10 billion, it's considered a mid cap, a middle capitalized company. Usually between half a billion and 2 billion is considered small cap, and then less than half a billion is considered micro cap. Okay. All that means is understanding your scale of the company. Is it a big company? It also tells you a little bit if it's a value company or a growth company. Very likely, if the market cap is above 10 billion, it will have a dividend attached to it. We'll talk about that in a second.
So when I was kind of dabbling in the crypto world, the market cap was kind of important because when you were looking at getting in early or something like that, you wanted something that had more ability to grow.
Yeah.
So when you looked at a smaller market cap, that was a little more like we wanted to go for those because if you looked at like at the time Bitcoin, which had one of the largest market caps in crypto, like the odds of that doubling to double your money or whatever was much less.
It's the same scenario in a stock, right?
So you want this, not want, but I guess it's...
Well, so that, no, what you described is actually the next thing I want to look at, which is beta.
Okay.
Risk. Before we go to beta though, another question.
Where do you find the amount of shares that a company has?
Oh, for market cap?
Yeah.
Okay, good question. So actually you can go to statistics. This is where you kind of jump around a little bit. You go to statistics. If you scroll down, it should have trading information here on the right. So it'll give you all the stock price history. Go under your share statistics here. You'll see a shares outstanding. So currently, the amount of shares that are outstanding for this company, right, is 4.24 billion. You take that, you multiply it by the stock price. That's where you get the market cap.
And sidebar question, is that a pre-decided upon number or what affects?
Great question. On that one, that's actually when you go to issue with a company stock, that's how you, don't take this word the wrong way, but that's how you manipulate stock prices a little bit. I don't mean that in a negative way. I just mean, hey, I'm going to issue 1 million shares at $5 a share, right? And then it gets into economics, right? Of supply and demand. Oh, people really want this company. It's going to drive up the share, but there's only 1 million shares outstanding. They could potentially issue more if they wanted to on a board thing, but it would dilute the share price, right? That's where it kind of comes around. Okay, good question. Which, by the way, now back to the capitalization side of things, right? This gets into the beta. That's the next thing I would look at. So a beta, just so you know, is a metric of risk. It's a measurement of like how much risk a stock has. Now, this is kind of, usually you see a beta, it says 5-year monthly. You see this is 1.71. They kind of use as a marker of like 1 as being kind of neutral, okay? So if it's less than 1, it's kind of more of a safer environment. If it's more than 1, it can tend to carry higher risk, okay?
So it makes sense. It has a more ability to double, triple grow in that way, but
it's
that
risk.
comes with risk.
Correct.
So with less ability to, let's say, double, it's going to be safer.
Yes.
Gotcha.
Yes. Okay, so that's essentially the summary of some of the things we go through when you first look at a page. I'm actually going to go through, and I think it's wise for us all to go through on the statistics page. This is where you get to kind of more details. There are 3 ratios or things that I think combine a lot of the things we already spoke about together that are, I think, really good. That's something we look at fundamentally for a company. The first one I want to bring up is earnings. Now, I always kind of go down here into the statistics and go down to financial highlights. And under the income statement portion here, you're going to see this quarterly earnings growth. To me, that gives a pretty good explanation to other things we just went through, like the price to earnings. Remember I said it was a little bit high? It makes sense because the growth year over year quarterly is growing gangbuster. It's like almost by 30%, right? Why are you laughing at gangbuster?
Just your
That's
references. I don't know.
My references.
30 is good.
So I think it's really important when you look at that. Earnings matters. This is why when you see quarterly earnings results coming out for companies, you see a positive reaction if they're good earnings, right? That means they're doing something right. Okay, so I think earnings is a good one to look at. The bigger one that I like to focus on, and this to me is a good one, is the PEG ratio. All right, so I'm going to read this definition because I want to make sure I get it succinct, and then I'm going to make sure I boil it down into our world.
Perfect.
So the PEG ratio, and I'm going to explain this in a second, but the PEG ratio measures the relationship between a company's price to earnings ratio that is divided by expected earnings growth rate over the next 5 years. Okay, I know, that's a lot, but here, let me break this down. Basically, it's price versus growth. Are you paying a fair price for the growth of this company?
Because you don't want to be paying high prices if that company is not growing.
Now, the 5 year is really important here. 5 year expected. They're expecting the growth to be X. And so you have to go in and say, okay, if that number, how does that look in the relative currently on the price currently trading on right now? Okay? I figured out questions. Go.
My hand was up first. Okay.
You go first. Girls first.
Growth based on what? What factors do they look at based?
Well, as a company, it's like,
hey, I asked that correctly.
Yeah, and I understand.
Like, what factors affect the growth?
So this on quarterly calls, you'll see a company, right, talking about, hey, we're looking at this initiative, we're investing in this vertical to grow this line of the business, right? We're expecting it to grow at this rate. And you put that all together, and that's what they expect the growth of the company to be at.
Actual physical or revenue growth.
Yeah, revenue growth, and then they equate that to a percentage, right?
Sure.
Does that make sense? Did I answer that?
Yeah, it just seems a little adventurous to.
Well, there is some
expect a 5 year growth.
There is some hypotheticals to it, but the reason why 5 years is an important one to look at, it's not a year because a lot of things can happen within a year and disrupt it, and 5 years is not too far out.
Okay.
Right. It's just something that we generally have used as an example.
Right. And how reliable is that?
Like anything else in life, it's reliable to the point that data is put in.
Yeah.
So we're trusting in a lot of scenarios here.
I mean,
this is right or wrong. I'm not sitting here to say this is the best system, but it's the way it's run.
It's a lot of,
so
to put it simply, educated guessing.
Yeah, I hate when people say that, but I mean, look,
I don't mean science there is too, though. It's a hypothesis.
Yeah, I don't mean that.
Like in a business, there's pro formas. Like if I invest $10,000 into this idea, I'm expecting it to generate this based on the inputs. I could be wrong.
Yeah,
and that's the job of analysts. That's the job of investors for us to gauge how good the board is at these numbers, how good your CEO is. They have a big job to do, and they're held accountable for these numbers.
It's any forecasting is.
It's any forecasting.
I mean, it's simplifying and saying educating guessing, but that's what it is.
Yep. Now, this number of 1.29 needs to be contextualized, right? A PEG ratio of 1 is considered fair value. If it's less than 1, it's undervalued, and if it's over 1, it's overvalued. So technically, right now, they're saying based on the 5 year expected growth rate and the current price, it's a little overvalued. What does that mean? It just means you might be paying a little bit more right now than what it might really be worth based on that one scenario.
And that was similar to the beta.
Yes.
That
same kind of marker.
That kind of correlates.
Yep. Okay. The last one I want to bring up is this idea of enterprise value and EBITDA. Okay.
EBITDA?
EBITDA. There's a movie on that. So enterprise value is really important. Essentially, up here on this, you have the market cap, which we already went through, right? The enterprise value is essentially what does it cost to buy this company?
If I want to buy the whole company cash, that's what it's going to cost me.
Basically, it's saying how expensive is this company relative to its operating cash flow. Okay, that's enterprise value. That's how big it is. Now, the reason why what enterprise value says and what it's worth versus EBITDA. EBITDA is a accounting term which stands for earnings before interest, taxes, depreciation, and amortization. I'm not going to go into all that, but just understand this. You ever heard the term multiple before? Oh, a 10x, 8x, right? You heard this before?
Yeah. I've heard you say it.
This is where you get this from, right? So for example, enterprise value divided by EBITDA, they're basically trending at a little over a 10x, a 10 multiple. Now, again, this is harder to say this because every industry has different multiples, but generally speaking, the basic rule of thumb is if it's less than a 6x, it's considered cheap. If it's between 6 and 10, it's kind of fair. And if it's over 10, it starts to get expensive. And then you get into the high teens, it gets really expensive. Again, this is a textbook answer and it varies between industries. But in this scenario, it gives you an idea, right? That the actual, you can see the value's actually gone down. Currently it's at 10.7, right? The multiple has gone down from where it was a year ago. Question?
So is it better to buy, like I know the rule of thumb is like buy low, sell high, you know, but is it better to buy it when EBITDA is around a fair price?
Yes. It's a cheaper buy on a multiple perspective.
Right. Okay.
Those three I think are really important that I've talked to my analysts about, and we kind of all tend to agree on this one. It's kind of looking at what the earnings that the company's doing. The PEG ratio I think combines earnings per share, price to earnings, and it looks out 5 years. That's why I think the PEG ratio is a good one. And I do like this enterprise value in EBITDA because it gives you the multiple of the business. It gives you what it's trading at. Is it fair? Is it undervalued, overvalued? So hopefully that gave you a good sense on how to look at a stock. What I'm giving you is the textbook answers, but the reality is, and I think everyone should know this, investing is way messier. It's not easy. If it was, everyone would be doing it. Wouldn't you agree? Now, I'm not expecting everyone to go and build a portfolio around what I'm saying to you here. I just want you to be a little educated as you know some of these things and how, and I'm not doing the best job of describing it, but the reality is it's important for you to know at least the context of what is out there for information to get.
That's fair. What this has taught me is that I need to have a financial planner in my life because I don't want to get in the weeds with all these numbers and have to worry about it. I mean, it shows how really complicated the system is, and having somebody on your side to really like either walk you through it or somebody that has a team of researchers to do this for you. Like that's just like nice.
Yeah, like I agree with you. I think counsel is a really big thing for a lot of clients. I think if this is confusing to you, it's just kind of a baseline. Meet with somebody, talk with them. I think that's really important.
Yeah, more eyes, more brains.
More eyes, more brains. Not a bad deal.
Yeah, cool.
I hope you guys enjoyed that today. We had some fun going through this. Hope it was interactive here. Thank you for all the subscribers who do watch. We're very grateful to all of you. And as always, if you lead with love, it's going to be all right. See you guys next week.